Hello and welcome to Livewire Markets Income Series for 2025. My name's Tom Richardson and today I'm sitting down with Ben McVicker, the co-portfolio manager from the Magellan Global Infrastructure Fund. Ben's going to talk to us about how the fund generates income and how he thinks about making money in markets today. Ben, welcome.
Thanks for having me.
Okay, first up, can you tell us about the fund structure, how many stocks it typically holds, how it pays distributions?
So when we think about what we're trying to do with the strategy, what we're really trying to do is, at a primary level, is build a portfolio of very defensive, reliable infrastructure companies. But I think really important that goes with that is we're also trying to develop a portfolio that's got not just income, but also structural growth that sits behind those cash flows as well over time, including very inflation-protected cash flows over time. When you think about what we actually do with the portfolio, very typically we're holding between 20 and 40 companies. You'll typically find us holding about 30 companies in the portfolio. As we stand today, just to give you a flavour of what the portfolio looks like, we have pretty much a skew to probably more in the European, UK markets, where we probably see a little bit more value in the portfolio. And what you'll typically find is, we've got a global mandate, but we've found great opportunities in developed markets over time. Now, to your questions on the income and how that plays out over time, when we think about income from the portfolio, I think it's pretty well understood that infrastructure companies are pretty reliable defensive businesses. When we look at the underlying dividend yield, sort of the running yield of the underlying companies we hold, of the circa 30 companies, you're looking at just a touch under 4% yield from those companies, and that's really the anchor for the yield from the portfolio. And then when you think about the actual way the fund itself, the structure pays distributions, we target a 4% payout, and we pay biannually out of the strategy.
The fund's investing philosophy, how do you pick stocks that will generate income for the investors and protect their capital?
Yeah, I think this is where the conversation gets interesting in infrastructure, because what we really think about is, and what we really call our definition of infrastructure is really it's really our investing philosophy, how we think about investment in this space. So what we do is, start with the basics. I think everyone implicitly understands what a piece of infrastructure is. When you think about infrastructure as an investment, though, it's a little bit different, right? So at its high level, infrastructure is a capital-intensive, expensive bit of equipment that serves communities, economies, etc. When you then think about what you actually want to do as an investor, though, you want it to deliver dependable cash flows. So what we say is not only must it deliver essential services, because that gives you very reliable demand over time for those assets, so people don't tend to, at a simple level, turn off their running water because times get tough in the economy, nor these days, electricity, that just gets more and more important as we move up the tech stack in terms of what relies on the electric grid day to day. I think people realise how much they rely on that. And so again, very defensive against the economic cycle. But what we then do is say, look, that's the starting premise. We also then want to end up with a portfolio of very reliable cash flow generating assets. So what we do is we say we want to remove anything with too much sovereign risk. It's all well and good if you're earning money, but if the government just takes it from you, it's not helpful either. Anything with too much competition risk, and anything that's too exposed to commodity prices. Now, underscore prices in that sentence, because really it's the movement of commodity can be a stable business, but when you're reliant on the very volatile price of commodity, it's hard. So in a nutshell, what we end up with is, call it 350 companies in the infrastructure universe. We filter that down to about 130 companies that we call our sort of universe for investment, the pond from which we fish, and we select assets out of that. So, I'd probably say that as a starting premise, to your question, that's really one of the key parts, is we try to find a great portfolio of businesses, but we already spend a lot of intellectual effort trying to define what we actually want to invest in the first place.
So you put your portfolio together. Do you have a targeted income return?
Yeah, when we think about the return, generally what we're seeking to do is deliver attractive risk-adjusted returns. And we talked about the yield, and that's been pretty stable. My observation is the yield has typically grown over time at a pretty reliable rate over the years. But what we generally think infrastructure investors should expect from a high-quality portfolio is probably something like CPI plus 5, so call it a real 5% return. The reason we break that up is infrastructure tends to be pretty well protected against inflation. The underlying cash flows, so motorways can increase their tolls by inflation, airports, their charges, utilities, you can increase your prices you charge for inflation. So you've got a pretty good protection there. It's really important to note that doesn't mean it's not a capital protected against inflation annual type strategy, but you get the cash flows, and ultimately we have a view that where the cash flow generation goes, the share prices go over the long term, and so that's what protects you in that sense. So generally thinking, CPI plus 5 is probably a reasonable return expectation for investors in this space, and split somewhat between the yield and the sort of growth over time.
Great. So can you tell us about a couple of income generating stocks you think people should know about?
Yeah, sure. Happy to talk about a couple of holdings that we have in the space. So a couple that jump to mind, they're just sort of larger positions in the strategy for us. One is Ferrovial. They're a European-based business. They have, if you actually think about where their assets are, they might be European-based, but they are vastly majority North American, so USA, Canada. One of the things, just to call it, that's pretty attractive about them is one of their crown jewel assets is the 407 ETR in Toronto, Canada. This is the type of concession asset that's kind of hard to replicate. It runs out into the century. It's got a concession life that's very long, and unlike a lot of Australian motorways, it's got a toll price structure that's somewhat uncapped. There are caps on it, but you can materially push up tolls in that over time. And as you imagine, you couple a very long concession life with an ability to push up tolls, plus you get population growth. Toronto's a growth corridor, a growth catchment, sorry. And because of that, you get a pretty attractive compounded growth out of that asset. And then in the US, they've got the same but not the same type of assets where they're actually toll roads attached to free motorways, where effectively they call them ways of getting around the traffic. So effectively, you've got a variable charge that you can jump onto on these roads, and ultimately the price is variable, so it keeps them flowing free. So again, really attractive long-lived assets, multi-decade concessions. Another one that we've got as well is Aena. They're a Spanish airport business. Really attractive set of assets. You think about what makes them an attractive system is they've got key assets in places like Madrid and Barcelona and a lot of other regional and city airports. But what makes them particularly attractive is the way that their traffic indexes. So they're much more short haul oriented. So Northern European, UK travellers, they have a very high leisure and holiday penetration. Again, that's tended to trend a little bit better than business travel in recent years. And likewise, it's got a very very high low-cost carrier penetration. And so again, that's been a part of the market that's performed quite well. So, really attractive asset that you can see very strong growth out of that business over time.
You touched on the fact that you own utilities earlier, gas and electricity. Why do you like those kind of stocks?
Yeah, utilities are really the sort of lead in the keel, bedrock type investments in an infrastructure portfolio. You think about what they do. They provide essential services. They typically get attractive growth because you've got to reinvest in the networks. You get paid for your investment. And one of the other things that's particularly attractive is you get this structural growth that comes attached to them. So if you think about a fair return in somewhere like the US, might be between 9 and 11% return on your equity capital you invest, which from our perspective for the risk you're taking, that's a pretty attractive investment. So just to give you maybe a bit of flavour for that, so one of the companies in the portfolio is company Italgas. They're the largest gas distribution network operator in Italy. They've grown a little bit through organic, a little bit through acquisition, buying some of the small operators. And more recently, they've acquired the second largest operator there. So this is a pretty vanilla set of assets, right? A gas network. But one of the things it really has going for it is it's got a very strong executive team, and they've really run this business with a lot of discipline over time. And so what you've seen is that they've actually managed to drive earnings that exceed probably what you'd expect out of the asset. So it's a long-term asset, but they've done really well over time.
And what sort of yield would Italgas
pay? Well, you typically find in the European market anywhere between sort of 5 and up you can get in that market.
To finish up, we all know there's a lot going on in the world right now in terms of macro, geopolitics. So how are the fund's infrastructure bets positioned for the future?
When you think about infrastructure in general, one of the things that we've got going for us is infrastructure done right shouldn't have a lot of exposure to some of these geopolitical events. No one's immune, but generally these are more defensive assets in the first place. So when you think about, for example, tariffs are a great case in point. So if tariffs were to impact the economy, infrastructure is pretty well protected in that environment. This might take a bit of an impact, but generally the demand is going to be pretty reliable on those assets. And also, if you think about tariffs go up, pushes up the cost of steel and other input costs. If you're a utility in North America, you have an ability to actually pass that through to ratepayers. So ultimately, you get to pass on that problem somewhere else. It becomes inflationary from a utility rate perspective. So you're a bit more insulated on that front. But we've actually had a portfolio tilt in recent years that's probably is a little bit more, as I said before, to that sort of European, UK market. We've found good value there. I mean, I think most people who follow markets know that's probably closed up a little bit. We still see good opportunities, as I just talked about some of the companies in that space there. So I think in general, that's, the things that are happening, we're watching closely, but, from an asset point of view, we remain pretty comfortable. And then the other thing I just comment as well in terms of the current macro landscape is we think, in recent years, we've just gone from a period of time where you had, COVID low interest rates to what you'd probably consider more normal long-term interest rates in most markets around the world. That's a much more favourable setting for infrastructure as it stands today. That move from low to sort of more average, obviously is tougher for longer duration assets. But now we've got a situation where you've got rates that are more call it normal. And in that environment, you'd expect infrastructure to be much more in the viewfinder doing that sort of CPI plus 5 type return outcome.
Okay, I think the RBA's own forecasts are for rate cuts this year. The Fed's dot plot is forecasting rate cuts, so is that a positive for your portfolio?
Certainly to the extent that it brings down probably the longer rates is more what we think about. Short-term rates, it might be marginal, but it's probably the longer rates we think about. So it really then depends on it's a technical issue of does that steepen the yield curve or not. If that happens, then I suspect it's somewhat more neutral, but it's supportive nonetheless.
Great, thank you very much, Ben. If you'd like to see more content like that from Livewire's income series for 2025, please visit our website at livewiremarkets.com or visit our YouTube channel.